So really good information. We've talked about building your business, identifying what your product is, starting to actually create a system to follow with your clients. We talked about dealing with management issues, dealing with contractors, dealing also with real estate investor and brokers, and how to find the transactions. So what we're going to do now that we've gotten kind of a real mindset of how the business flows and what to do, I think the next real logical step is to then begin talking about the actual real estate business itself. Would you guys agree?
Sure.
All right. Before I start rolling, there's a lot of content that we're going to cover. So we're going to go a little fast. So if it's going too fast, and you're kind of over your head for a second, and just raise your hand and say, slow down for just a second for me, all right? I will ask somebody in the audience to do me a favor. 4:30. We have to take a break. And everybody who has a car in that parking lot has to go square with Willie. All right, so
because he goes home at 5.
Exactly. So we want to make sure that at 4:30 we stop what we're doing, quick break, go out there, stretch out. When we come back is when we're going to meet with our attorney, who's going to cover some very valuable information that would cost you thousands of dollars, literally, to get from an attorney when you consult with them. So it's definitely very valuable that we come back quickly so that we can honor his time, because I've already got to bump him and he's expensive. Right? So I want to make sure everything is in order and you guys really get as much value out of this as possible. So with that said, what we're going to begin talking about today is the residential business, how to operate it. Now, in our model, the primary residential acquisition strategy that we apply is a very simple buy, fix, and flip. However, we believe in having an established portfolio investment. And I believe in anything that you get into, especially when you're investing, you should be investing through a portfolio strategy, which means you shouldn't just have one specific real estate transaction that your money is tied to. As an investor, I actually focus on one thing. However, it will evolve over time, offering different services so that your investor's money is diversified. Let me give you an example. Let's say I take an investor. I put 100% of his money in the flips. And that's all I ever do. They just keep rolling the money. It might be 9 flips. It might be 20 flips. But somewhere down the road, this window of opportunity is going to disappear. So what now happens to this investor? Anybody know?
Done.
He disappears.
Yeah, pretty much gone. Why? Because you have not already produced a system that has generated income streams for them and other revenue. So now they're saying, hey, all you knew was flips, that's all I'm going to trust you with. You see what I'm saying? So you may start in one, but you want to quickly identify areas that you're going to specialize in over time. It might be bringing in some partners at that time and doing certain transactions strategically. But you want to make sure you offer a balanced strategy. Number one, I said it's valuable for you long term to have a sustainable real estate business. But second of all, and most importantly, it is so that you protect your investors' money. Because if one of those strategies goes wrong and you've got no parachute behind you, you've got major problems. Especially when you're dealing with millions of dollars. Do you guys agree?
Absolutely.
So by diversifying the risk into different brackets that produce different types of returns, we play it with what we call the 40-40-20 plan. 40% of all of the assets that we look to purchase are assets that we can realize the appreciation. That would be considered the buy, fix, flip business. There are windows of time where that turns to 10 because the market changes. Like when the market is going down, it's very difficult to buy assets. So we might change that percentage slightly. But I want you to kind of get the context behind this. 40% should always be, at least 40%, should be cash flow based. These are properties that you invest in that yield a cash flow every single month. We did an analysis on one of our private placement offerings that we had. And believe it or not, we did a 60-40. 60% of the money was actually in residential flips. 40% was in commercial properties that were producing cash flow. And this is what I want to give you a picture of, okay? We've got over $1 million in this private placement allocated, which means what? $600,000 is going to what? The fix and flip. $400,000 is going where? Cash flow. Here's what's powerful about the higher risk, higher reward get. When we broke down the numbers, even if the 60% disappeared tomorrow, I mean you lost the investor's money. That 600 grand, gone. You would still, because you have 40% in commercial real estate, be able to yield a 6 to 8% return for your investors' annual return on the full amount that was invested.